For most of history, people don't notice when a system starts failing. Because failure doesn't begin with chaos, it begins with comfort. When a currency becomes powerful enough, it stops feeling like a tool and starts feeling like nature, like air, like gravity. Something you never question because it has always been there. That illusion has fooled every empire that ever held global power. Spain believed silver would last forever. Portugal believed control of trade made them untouchable. The Dutch believed finance itself was invincible. Britain believed empire guaranteed permanence. None of them were stupid. None of them were careless. And none of them thought collapse was possible until it was already unavoidable. Every reserve currency followed the same sequence, not because history repeats itself, but because systems do. Today, the US dollar sits at the center of everything: energy, trade, debt, markets. It feels so embedded that imagining a world without it sounds absurd. That's exactly how it always feels. The dollar became the global reserve in 1944. Decades passed. Confidence hardened into belief. Belief hardened into certainty. And certainty blinded people to the math underneath. This isn't about politics or ideology. It's about structure. A 7-stage cycle that has governed global money for over 600 years. Slow enough to ignore. Predictable enough to deny. And once it reaches its later stages, impossible to stop. The unsettling truth isn't that collapse might come someday. It's that by the time people start debating it, the system is already inside it. And history never waits for permission. Every reserve currency collapse begins with the same mistake. Not weak armies, not empty treasuries, but belief. The belief that this time is different. When a currency sits at the center of the world for long enough, permanence starts to feel natural. Entire generations grow up knowing nothing else. Markets price everything in it. Governments plan around it. People save their lives in it. And slowly, quietly, the idea forms that this system isn't just dominant, it's permanent. Portugal believed that when its ships controlled the oceans. The Dutch believed it when Amsterdam became the financial heart of Europe. Britain believed it when the sun never set on its empire. And America believes it now, because permanence doesn't announce itself as arrogance. It disguises itself as confidence, as stability, as common sense. Why question the system that feeds you? Why doubt the currency that pays your salary, funds your government, and underwrites global trade? This belief is the most dangerous stage of all, because it makes decline invisible while it's happening. The currency doesn't collapse overnight. Nothing dramatic breaks. Life continues. Markets function. Stores stay stocked. And that's exactly why people miss it. By the time doubt enters public conversation, the foundations are already compromised. The debt is already too large. The deficits already permanent. The incentives already broken. Every empire assumes decline looks obvious. It never does. It looks like normal life, just slightly more expensive every year. It looks like stability, quietly eroding from the inside. And the moment a society becomes convinced its currency cannot fail, history says it already has. To understand why this pattern repeats, you first need to understand what a reserve currency actually is. It isn't just a strong currency. It isn't just widely used. And it isn't about national pride. A reserve currency is the money the world is forced to use. When countries trade with each other, they don't settle in trust. They settle in currency. When oil is sold, when food crosses borders, when debts are paid, one currency becomes the neutral ground everyone agrees on. That currency becomes the reserve. It's what central banks stockpile in their vaults. It's what global commodities are priced in. It's what international loans are denominated in. When your currency becomes that standard, something extraordinary happens. The entire world needs your money, even if they don't need your products. To buy oil, they need your currency. To balance trade, they need your currency. To hold safe assets, they need your bonds. This creates what economists call privilege. But privilege is too soft a word. It's power. You can print money and exchange it for real goods. Other nations must work, produce, and export to earn that same currency. You can run trade deficits without consequence. Because the world needs your money more than you need theirs, you can borrow cheaply, endlessly, because global demand for your debt isn't optional. It's structural. This is why reserve currency status is the ultimate economic weapon. It replaces armies with balance sheets, cannons with contracts. Except 5K characters. And it's why empires fight to achieve it, and why they collapse once the cost of maintaining it becomes greater than the benefit. Because the same system that gives a nation extraordinary power slowly rewires its economy in ways that guarantee future failure. And once that process begins, it doesn't stop on its own. History doesn't hide this process. It repeats it, over and over. Every reserve currency passes through the same sequence of stages. Not because leaders make the same mistakes, but because the system itself produces the same outcomes. Think of it less like a political failure and more like gravity. Once a nation reaches reserve currency status, certain things become inevitable. The incentives shift, the behavior changes, and the path forward narrows until only one direction remains. This is the seven-stage cycle. It always begins the same way, with dominance, with control, with undeniable strength. That strength forces the world to use your currency, not by agreement, but by necessity. Then comes wealth, massive surpluses, capital flowing inward from every corner of the world. A golden age that convinces the nation it has cracked the code of history. At the peak, the world formalizes what already exists. Your currency becomes the official standard. The system locks in. And paradoxically, that moment of recognition becomes the beginning of decline. Because from that point forward, the world needs your money more than your goods. Production slows. Consumption rises. Deficits replace surpluses. Debt replaces discipline. And when borrowing reaches its limits, money printing takes its place. Confidence erodes, quietly at first, then visibly. Nations begin searching for alternatives, not out of rebellion, but survival. And finally, the replacement happens. Not with a speech, not with an announcement, but with abandonment. The world simply moves on. 7 stages, 4 completed cycles, 6 centuries of evidence. Once a nation passes the midpoint, history shows no examples of reversal, only variation in speed. The only question is never if. It's where you are when you realize it. And right now, that's the question facing the dollar. Every reserve currency is born the same way, not through trust, not through innovation, but through control. Before a currency can dominate global trade, its nation must dominate the roots trade depends on. This isn't about raw military strength. It's about controlling the arteries of the world economy, the narrow passages where commerce has no alternative path. Ports, straits, canals, sea lanes. Whoever controls those controls trade. And whoever controls trade decides which currency matters. Portugal was the first to understand this. In the 15th century, while most of Europe stayed near the coast, Portuguese ships crossed open oceans. In 1488, they rounded the Cape of Good Hope, opening a sea route to Asia that bypassed Ottoman-controlled land routes entirely. That single breakthrough reshaped global commerce. Portugal didn't just trade through these routes, it militarized them. Fortified ports appeared at strategic choke points across the Indian Ocean and beyond. Goa, Malacca, Macau, Mozambique. These weren't markets, they were armed checkpoints. If you wanted spices from Asia, you paid Portugal. If you wanted to trade in those waters, you used their currency. If you refused, your ship was seized or sunk. The Portuguese Real became an international currency not because it was better, but because cannons enforced it. The Dutch followed the same pattern in the 17th century. Their East India Company wasn't just a business, it was a state-backed military force. Trade followed power. Britain later perfected the model. And after World War II, the United States inherited it. This is stage 1, overwhelming control of global trade routes. Once a nation reaches this point, the rest of the cycle begins automatically. Wealth starts flowing in, not slowly, not evenly, but relentlessly. When trade is forced through your system, you capture the spread. You buy goods cheaply at the source and sell them dearly at the destination. You don't need to innovate. You don't need to outproduce. You just need to sit at the center and take a cut of everything that passes through. This is the age of surpluses. Portugal experienced it first in the 16th century. Spices from Asia, silk, porcelain, all passed through Portuguese-controlled routes. These goods sold in Europe for many times their original cost. Ships returned to Lisbon heavy with profit. The trade surplus was so large that the crown could fund its government without heavily taxing its own people. To the outside world, it looked like genius. To those living inside it, it felt like destiny. The Dutch took this model and refined it. Amsterdam became the warehouse of the world. Goods from Asia, Africa, and the Americas flowed through Dutch ports, were stored, insured, financed, and resold. The Dutch weren't just traders. They were global arbitrage machines. Buy low in one market, sell high in another. Capture the difference. The surplus built immense wealth. Canals lined with mansions, merchants richer than kings. A society convinced it had discovered a permanent advantage. Britain followed in the 19th century. Manufactured goods poured out of British factories while raw materials flowed in at prices set in London. The trade surplus financed an empire. Railways, shipyards, financial markets. London became the financial capital of the world. After World War II, the United States experienced the largest trade surplus in history. Europe and Asia were rebuilding. American factories stood untouched. The world needed machinery, steel, automobiles, and consumer goods, and America supplied them all. Dollars flooded into foreign central banks faster than they could be spent. Gold piled up in Fort Knox. The surplus felt endless. This is stage 2, the accumulation phase, and this is where every empire makes the same mistake. They assume the surplus is permanent. At some point, the world stops treating dominance as temporary and starts treating it as law. That moment is stage 3. This is when reserve currency status becomes official. What was once enforced through power is now written into agreements, treaties, and institutions. The world doesn't just use your currency, it builds systems around it. For Portugal, this happened in the early 16th century. Trade contracts across Europe and Asia were denominated in the real. Merchants didn't debate it, they accepted it as the standard. The system locked in. For the Dutch, it happened in the mid-17th century. The guilder became the currency of international finance. Bills of exchange were written in guilders. Even foreign empires used Dutch money because Amsterdam's markets were the deepest and most liquid in the world. Britain reached this moment after the Napoleonic Wars. In 1815, the Congress of Vienna formalized what had already become reality. The pound sterling was recognized as the global standard. The gold standard spread, but in practice, it was a pound standard. Britain set the rules. Everyone else followed them. The United States reached its peak moment in 1944. At Bretton Woods, 44 nations gathered and redesigned the global financial system. Other currencies were pegged to the dollar was pegged to gold. The IMF and World Bank were created to manage the system. This was the most explicit reserve currency agreement in history. And this is the part no one likes to admit. Stage 3 is the high point, the absolute peak. Because once the world officially adopts your currency, it stops needing your products. It needs your money. From that moment on, the incentives flip. Production becomes optional. Consumption becomes easy. Deficits become necessary. The system that crowned you also planted the seeds of decline. And once that switch flips, there's no switch to flip back. Once reserve status is formalized, a trap snaps shut. The world now needs your currency more than your goods, and that single shift changes everything. Factories don't disappear overnight. Workers don't vanish, but incentives begin to rot. Why struggle to produce when you can import? Why export goods when exporting currency is easier? This is the hidden mechanism behind every reserve currency decline. For the global system to function, your money must circulate everywhere. That means you must send it abroad. And the only way to do that, year after year, is to run trade deficits. This is the Triffin dilemma. In simple terms, the same force that makes your currency global also makes your economy fragile. Stop running deficits, and the world runs short of money. Keep running deficits, and your currency weakens. There is no third option. Every reserve currency faces this contradiction. Each chooses the same path, not because leaders are foolish, but because the system allows no alternative. Portugal stopped exporting and started importing. The Dutch shifted from production to finance. Britain moved from manufacturing to living off overseas investments. Wealth was no longer created. It was extracted from the past. At first, the transition feels painless. Incomes stay high. Stores remain full. Credit is abundant. When production fades, the illusion remains. This is what makes stage 4 so dangerous. The nation doesn't feel poor. It feels comfortable. Wealth still appears everywhere. Cities look rich. Consumers spend freely. Governments expand programs. Living standards seem high. But none of this is powered by new value creation. It is powered by stored wealth. Portugal learned this in the mid-1500s. Instead of exporting goods, it imported nearly everything: grain, textiles, manufactured products. Payment came from gold and silver pulled from overseas holdings. As long as that metal arrived, nothing felt wrong. The crown spent lavishly. Palaces rose, courts expanded. Military costs ballooned to defend trade routes that were growing harder to control. No one noticed the shift because money kept flowing, but it was no longer income. It was liquidation. The Dutch followed the same path later. After decades of surplus, production faded. Citizens lived off accumulated capital. Investment moved from factories to lending. The Netherlands became Europe's banker instead of its workshop. Returns still arrived. But nothing new was built. Britain repeated the pattern in the early 20th century. Manufacturing declined, while overseas investments funded consumption at home. The country looked wealthy, but the engine had stalled. This is stage 4, living beyond means. The United States entered this phase quietly. No announcement, no emergency, just a shift that almost no one noticed at the time. In 1971, the United States ended the last link between the dollar and gold. From that moment on, the trade surplus that had defined American power after World War II never returned. What followed wasn't collapse, it was convenience. Factories began moving overseas, cheaper labor, higher margins. Consumers benefited from lower prices. Corporations benefited from global supply chains. Politicians benefited from growth without sacrifice. Imports rose, exports lagged, and the trade deficit became permanent. By the 1980s, the United States was importing far more than it exported. By the 2000s, the deficit had exploded into the largest in history. Hundreds of billions of dollars every year flowing out, paid for not with goods, but with currency. Dollars were exported instead of products, and it worked. For a long time. Store shelves stayed full, inflation stayed low, living standards appeared high. The world accepted dollars because it needed them for reserves, trade, and debt. But this was the same illusion every empire experienced. America wasn't getting richer. It was spending its position. Manufacturing hollowed out. Skills disappeared. Supply chains stretched across oceans. The economy shifted from building things to moving money. None of this felt like decline. It felt like progress. That's what makes Stage 4 so deceptive. Because by the time the consequences become obvious, the foundation is already gone. When deficits grow large enough, borrowing stops being a choice and becomes a necessity. When borrowing reaches its limit, only one option remains. You print. This is Stage 5. Every reserve currency reaches this point, not because leaders want to destroy their money, but because the system leaves no alternative without immediate pain. Raising taxes is politically toxic. Cutting spending triggers unrest. Reducing deficits crashes growth. Printing money feels painless by comparison. Portugal reached this stage in the mid-1500s. As trade revenues fell and costs rose, the crown debased the real. Coins contained less silver. More currency circulated than the economy could absorb. Prices climbed. Trust eroded. Merchants noticed first. They demanded more coins for the same goods. Some rejected the real entirely. The currency did not collapse overnight. It slowly leaked value. The Dutch followed in the 18th century. War and empire strained finances. Borrowing grew expensive. Printing filled the gap. The guilder lost its reputation for stability, and once that cracked, it never fully returned. Britain repeated the pattern through 2 world wars. To survive, it printed. Gold backing ended. The pound was devalued repeatedly, erasing purchasing power and global confidence. The pattern never changes, because debasement seems temporary, but permanently destroys confidence once discipline is abandoned globally. The United States entered Stage 5 without calling it that. In 2008, the global financial system froze. Banks failed. Credit vanished. And to prevent total collapse, the Federal Reserve did something unprecedented. It created trillions of dollars out of nothing. This was called emergency policy, temporary, necessary, a one-time response to an extraordinary crisis. But emergencies have a habit of becoming normal. From 2008 to 2014, more than $3 trillion were created through quantitative easing. Markets stabilized. Asset prices rose. The crisis faded from memory, and the lesson absorbed by policymakers was simple. Printing worked. Then came 2020, a global shutdown, economic paralysis, and this time the response was faster and far larger. In just 2 years, more than $7 trillion were created. Stimulus checks, corporate support, government spending on a scale never seen outside World War. The money supply exploded. At first, it felt like relief. Then prices began to rise. Inflation wasn't framed as debasement. It was called temporary, transitory, a supply issue. But history has seen this language before. The effect was familiar. Every dollar bought less. Savings quietly lost value. Wages lagged behind prices. And because the dollar is global, the consequences didn't stop at America's borders. When the Fed prints, inflation is exported. Other nations holding dollars watch their reserves lose purchasing power in real time. This is what debasement looks like in a fiat system. Not clipped coins, but diluted value. Stage 5 doesn't announce collapse. It announces strain. And strain is when confidence begins to fracture. Slowly, then all at once. Confidence doesn't vanish overnight. It erodes. This is Stage 6. It begins quietly, far from public debate. Not with protests or headlines, but with balance sheets changing behind closed doors. Central banks start adjusting their reserves. Trade agreements quietly shift terms. Alternatives are explored, not announced. Portugal saw this first in the late 1500s. Merchants who had accepted the real for decades began asking for Spanish silver instead, not out of rebellion, but prudence. They had watched debasement eat away value, and they acted accordingly. The Dutch experienced it in the 1700s. The guilder was still used, still respected, but no longer trusted as the unquestioned standard. London replaced Amsterdam as the center of finance before most people realized a transition was happening. Britain's loss of confidence was faster. After World War II, massive debts and repeated devaluations shattered trust. In 1949, the pound lost nearly a third of its value overnight. Nations holding pounds learned a brutal lesson. Within 15 years, the world had moved on. This stage always looks the same. The currency still functions, markets still operate, governments insist stability remains. But behind the scenes, exits are being prepared. And once confidence breaks at the institutional level, it never fully returns. That's where the dollar stands now, not collapsed, not rejected, but quietly questioned. And history shows that once the questioning starts, the countdown has already begun. The signs are already visible, if you know where to look. Nations are not abandoning the dollar in anger. They are doing it quietly, carefully, gradually. The way you leave a building you are no longer sure is safe. China began reducing its dollar reserves years ago. At the same time, it accelerated gold purchases. Not dozens of tons, but thousands. Official numbers tell only part of the story. Unofficial estimates suggest far more. Gold does not default. It cannot be sanctioned. It cannot be printed. Russia moved after sanctions in 2014. As treasury holdings were liquidated. Dollar exposure was cut sharply. Reserves shifted into gold and alternative currencies. This was not ideology. It was survival. Then coordination followed. Brazil, Russia, India, China, and South Africa began discussing alternatives to dollar-based trade. Not as protest, but as insurance. In 23, they announced plans for a shared settlement system. Incomplete by design, the signal mattered more than structure. Even the petrodollar foundation cracked. Saudi Arabia accepted yuan for some oil sales to China, quietly and selectively. Central banks followed. Dollar reserves declined steadily, drifting into euros, yuan, and gold. This is stage 6, preparation, before transition accelerates across global finance. Stage 7 never arrives with an announcement. There is no vote, no summit, no declaration that the old system is over. It ends the way trust always ends, through absence. At some point, merchants stop pricing contracts in the old currency. Banks stop settling large trades with it. Central banks stop treating it as a foundation and start treating it as exposure. The Portuguese real didn't collapse in a single moment. It was slowly replaced by Spanish silver. Merchants preferred coins backed by active minds over a debased currency backed by memory. Within 2 decades, the real was irrelevant. The Dutch guilder followed the same path. As Britain's industrial power grew and London's markets deepened, trade naturally shifted. No one needed to ban the guilder. They simply stopped choosing it. By the early 1800s, it was regional, not global. The British pound's fall was faster. After World War II, repeated devaluations destroyed confidence. Contracts moved to dollars. Reserves shifted. By the 1960s, the transition was complete. Replacement doesn't require collapse first. Replacement creates collapse. Once a new standard gains momentum, the old one loses demand. And when demand falls, value follows, quickly. This is the phase everyone thinks they'll see coming. They never do, because by the time stage 7 is obvious to the public, the decision has already been made elsewhere. And when that decision spreads, the exit doors close faster than anyone expects. So what replaces the dollar? That question always appears at this stage of the cycle, and history gives an uncomfortable answer. There is never a clean successor waiting. When the Portuguese real collapsed, it was not replaced by design. Spanish silver took its place because Spain controlled massive, continuous production. When the guilder declined, Britain did not declare a takeover. Its industrial output and naval power made the pound unavoidable. When the pound fell, the dollar replaced it not through diplomacy, but because America held most global gold and the only intact industrial base. Replacement follows power, not intention. Today, no single currency meets every requirement. China has production and trade surpluses, but lacks military control of global routes. The yuan is not freely convertible, and capital controls limit trust. The euro is widely used, but Europe remains fragmented. Different debts, different fiscal rules, one currency, many governments. Under pressure, that structure strains. Gold is rising again, Central banks are buying at the fastest pace in decades. It cannot be printed or sanctioned, but it cannot scale to handle daily global trade alone. The most likely outcome is fragmentation, with regional currencies, trade blocs, and instability replacing global monetary order. And messy transitions are where real damage happens. What makes this cycle different isn't the pattern, it's the scale. Every previous reserve currency collapse was contained. Regional: when the real fell, it hit Portugal and its trading partners. When the guilder declined, Northern Europe absorbed the shock. When the pound lost its status, Britain and the Commonwealth suffered. But the world moved on. The dollar is not regional. It's everywhere. Global debt is denominated in dollars. Commodities are priced in dollars. Central bank reserves are held in dollars. Corporations borrow in dollars, even when they operate thousands of miles from America. Over $70 trillion in global bonds alone are tied to the dollar. That means when confidence in the dollar weakens, the damage doesn't stop at borders. It ripples through every balance sheet, every pension fund, every government budget on Earth. Emerging markets feel it first. Dollar-denominated debt becomes harder to service. Currencies weaken. Inflation spikes. Defaults spread. Then corporations feel it. Companies that borrowed cheaply in dollars face rising costs and falling demand. Bankruptcies follow. Then governments feel it. Reserves lose value. Budgets strain. Social systems crack under pressure. This isn't just a currency transition. It's a systemic reset. And resets are never gentle. They don't happen evenly. They happen in waves. Slow at first, then fast enough that institutions can't react in time. That's why the decline of the dollar isn't just another chapter in history. It's a global stress test. And no one knows who passes. This is where the story stops being abstract. Reserve currency collapse doesn't punish governments first. It punishes people. When the Portuguese Real failed, it wasn't kings who suffered most. It was merchants whose savings evaporated. Families who had stored wealth in coins that no longer held value. Generations of work erased quietly. When the Dutch guilder declined, Amsterdam's middle class was hollowed out. Savings lost purchasing power. Investments denominated in the old system stopped protecting anyone. When the British pound fell after World War II, an entire generation was impoverished. Pensions paid in pounds bought less each year. Bonds once considered safe destroyed wealth through inflation and devaluation. This is how currency collapse actually feels. Not like a crash, like slow theft. Prices rise faster than wages. Savings shrink without being touched. The future costs more than the past ever planned for. And this is already happening. Since 2020, the dollar has lost a significant portion of its purchasing power. What once felt affordable now feels out of reach. Housing, food, energy, education, everything costs more, not because it became scarcer, but because the unit measuring value became weaker. This is the human cost of stage 5 and 6. Not headlines, not charts, but lives slowly compressed. And history shows that once this process begins, it doesn't stop on its own. This is the moment where panic usually enters the conversation. So let's be precise about what this is and what it isn't. This is not a prediction that the dollar collapses tomorrow. It's not a claim that the United States will suddenly fail. And it's not a call to abandon everything you know. History doesn't move in explosions, it moves in probabilities. Ickish. Every reserve currency followed the same trajectory, not because leaders were corrupt or incompetent, but because the math made alternatives impossible. Deficits compound, debt accumulates. Printing replaces discipline, confidence erodes. The dollar is not immune to this math. Right now, the United States sits in the late stages of the cycle. Massive deficits, structural dependence on money creation, declining confidence abroad, quiet diversification by institutions that can't afford to be wrong. This is what late-stage decline looks like. The timeline doesn't promise exact dates. It offers ranges. The Portuguese Real lasted about 80 years. The Dutch guilder lasted roughly the same. The British pound lasted just over a century. The dollar became the world's reserve currency in 1944. We're already past the average lifespan. That doesn't mean collapse is immediate. It means the margin for error is gone. From this point forward, every shock matters more. Every crisis accelerates the process. Every round of printing shortens the runway. And once the final stage arrives, it doesn't give warnings. It arrives when the system can no longer pretend. There is one final detail that makes this cycle more dangerous than any before it. This time, there is no outside system waiting to absorb the shock. When the pound collapsed, the dollar was ready. When the guilder declined, British industry was rising. When the real failed, Spanish silver flooded global trade. Today, the dollar sits at the center of everything, and there is no clear replacement strong enough to take its place smoothly. That means the transition won't be a handoff. It will be a vacuum. And vacuums don't stay empty. They create volatility, confusion, competition, fragmentation. In that environment, wealth doesn't disappear evenly. It transfers. Those who understand the cycle reposition early, quietly, over years, not through panic, but through preparation. This is what Portuguese merchants did when they moved to Spanish silver, what Dutch bankers did when they shifted to London, what British elites did when they moved capital into dollars after World War II. They didn't predict collapse. They recognized pattern. And this is where the story turns from history to choice. Because knowing the cycle doesn't require fear. It requires awareness. Currencies rise and fall. Systems reset. That has always been true. What changes is who sees it early enough to avoid being the last one holding the old standard when confidence finally breaks. History doesn't warn loudly. It whispers until it doesn't. And the people who listen early don't escape collapse entirely, but they don't get crushed by it either. So what do you do with this information? Not panic, not denial, and not blind faith that someone else will fix it in time. The people who survive currency transitions aren't prophets. They don't time the collapse perfectly. They don't abandon society or bet everything on one idea. They diversify. They understand that holding all of their wealth in a single currency, especially one in the late stages of a historical cycle, is not safety. It's exposure. That doesn't mean abandoning the dollar if you live inside its system. You need it to function day to day. But it does mean recognizing that savings, pensions, and long-term wealth behave differently when confidence erodes. Across history, the same assets preserved value during transitions. Productive businesses, real assets, land, commodities, things that exist regardless of what unit they're priced in. The mistake people make is waiting for certainty. A certainty only arrives after the transfer is complete. By the time collapse is obvious, positioning is no longer possible. The exits are crowded, prices have adjusted, and the opportunity to protect purchasing power has already passed. This is why understanding the cycle matters, not to predict the exact moment, but to recognize the phase. And right now, by every historical comparison that exists, the dollar is no longer in its rise. It's no longer at its peak. It's in transition. The reserve currency cycle is not a conspiracy. It is not ideology, and it is not a theory waiting to be proven. It is a record. 7 stages, 6 centuries. Every global reserve currency without exception. They do not fall to invasion. They do not collapse from catastrophe. They fail because of arithmetic, slow at first, then faster than anyone expects. Portugal believed it was different, until it wasn't. The Dutch thought finance would save them. It didn't. Britain assumed empire guaranteed permanence. It never does. Now the dollar stands where they once stood. Not collapsing, not rejected, but no longer unquestioned. Stage 5 is here. Stage 6 is unfolding quietly. Stage 7 never announces itself. It arrives when confidence finishes breaking. History does not care about power, pride, or belief. It only responds to deficits, debt, and debasement. Those who understand this are not panicking. They are watching, adjusting, preparing, just as smart money has done before every transition. Because when cycles end, wealth does not disappear. It moves. And the final question is simple. Will you recognize the pattern in time or realize it only after the transfer is complete?